view that JPMorgan has now.
Yeah.
You know, just 24 hours ago, we thought growth had just broken down. And there were lots of people telling us that fixed income is a better idea than equities. What's the received wisdom now? That it's not as bad as that?
No, I think the sense is that global growth is still struggling, but the world is running at different speeds. And I think the sense is, at least in the US, that economy has reached escape velocity. The labor market's tightening quite meaningfully. If you look at the latest unemployment figure, that's now in the central forecast of the Fed in 2016 and 17. So we believe that on the whole, the fact that global commodities have collapsed so much is a positive for world growth. But clearly there are lots of moving parts here. A lot of emerging markets in Latin America will struggle. China's on a policy-induced slowing. But the G3 and the G4 are actually doing very well. If you cut out through the noise, the UK is about to raise rates, the US is doing well, Japan's accelerating as well. So I think on the whole, global growth is picking up. Developed markets are doing much better. Emerging markets are going to struggle a little bit because of the whole commodity fallout.
Brijen, what would the JPM view be on this FOMC meet itself? Are you all penciling a higher chance of a rate hike than a no rate hike? And how does that leave the world? Is it a day's turmoil and then actually, better tidings?
On the FOMC, I think what we are looking at is still a 50-50% chance of a rate hike. We think in terms of the data that has come, that's definitely supportive for a rate hike. The only thing which remains concerning is how global markets have reacted to the potential of a rate hike coupled with the China view. I think if China stabilizes and
which it appears to have.
It appears to have, but again we need to give it some more time. If it stabilizes and we do see a Fed rate hike, we think that if we do see a Fed rate hike, we definitely see the dots move lower. So the Fed would want to put a dovish tilt to it to ensure that it does not really roil the global markets. If that happens, then outside of the immediate day or two of a knee-jerk reaction, we think the market should settle down. And because whether it's September or December, it's something which is an eventuality. So the earlier, the better.
Okay, just hold on for a second. That's the newest kid on the block, Navkar Corp. The listing will take place in about 15 seconds from now, so we'll go across to that as and when it takes place. It's expected to be a weak listing. 120 to 135 is the expectation, but let's see what comes through. In terms of the business, remember it was oversubscribed this time quite a bit by almost 3 times. So, okay, that's the opening, 154, not bad. The expectation was about 120 to 135, but the opening for Navkar IPO has come in at 155. Now it's actually picking up a bit of pace, up almost about 1-odd%. Remember, it is trading at a premium to its peers like All Cargo and Concord in the logistics space, but there was a very good subscription. In a market like this, it was oversubscribed almost about 3 times, and that's actually a good listing.
Damn good day to list, actually. The mood is so good, but we must remind you yet again that the P ratios actually work very high for Navkar. It's almost 24 times FY16 earnings compared to All Cargo, which is at 13, and even Concord, the big Concord, is only at 21 times. This is trading at 24 times. If it had listed at that price of 154, but now trading at 160, actually the PE is ticking higher, but yes, it is a very good listing, a damn good listing and a damn good day to list. We'll revisit Navkar in a bit. The management should be joining us. But let's welcome Bharat Iyer as well into this conversation. Bharat, the key question really is whether emerging markets will continue to be a hated class. Is it that, the jitters are over, the worst is over, and we may start to see at least outflows stopping? What's the view?
I think as far as emerging markets are concerned, the house view is that, once the FOMC has done its bit, then relative enthusiasm for EM should pick up. But that said, I guess, if you're going to look at it on a 2-3 year basis, I don't think EM is going to perform very uniformly as a class. I think, there are going to be pockets that are going to be liked and pockets that are not going to be liked based on the relative growth, the inflation dynamic. And I guess in that context, India still looks very good to us.
Okay, so India still looks very good, but for a medium-term investor, Bharat, will equities continue to beat other asset classes like fixed income, etc.?
I think if you're looking at 3 to 5 years, yes. I think, our base case is that Indian equities deliver returns of about 10% through to March, April next year. This is going to be a year of consolidation after the 30% return we saw last year. And beyond that, we wouldn't be surprised to see returns in the region of 15 to 18% for the next 3 or 4 years.
Okay. Well, since Sonia spoke about fixed income, Sajjid, you've been more of one of the hawks in the space, but growth really did take a beating globally as well.
Right.
So what does this open up in terms of space for rate cuts?
I think India is one of those exceptional countries where a massive sort of commodity disinflation benefits us, right? A lot of other countries are forced to raise rates now. Brazil has, South Africa has, Turkey's tightened conditions. And so what you're seeing is that for the first time, I think there's a meaningful downside risk to the 6% inflation target that the central bank has. I think with, the global commodity index in dollar terms is the lowest since 2003. It's even lower than the depths of the financial crisis. In rupee terms, it's the lowest in 5 years. So the fact that commodities have collapsed so much in the last 3 months has been this double dip. And the fact that food prices remain contained for a variety of reasons we've previously discussed, despite a deteriorating monsoon, I think does open up a little bit of space for the RBI. We do pencil in a 25 basis point cut in September. But I'll just make one more point. Let's step back a second and think about the possibility of a cycle of cuts in the next year. We've had the best possible confluence of events. Commodities have collapsed, MSPs have been low, food prices are much below the historical averages, and we'll still end up with inflation around 5% by January when the dust settles. So that's going to give the central bank some pause. That growth is weak, there's no pricing power, every disinflationary force has worked in our favor, and we're still at 5%. So as a central bank looking forward, you have to say what happens when some of these forces reverse? What happens when pricing power picks up? And therefore, I think while we will get one cut in September, I don't foresee there being a cycle of cuts. Because if
there's a difference between one cut and a cycle of cuts.
Right.
There are some numbers in between.
Sure.
You told me there is a chance of a substantially lower number than 6%, and
Right.
you said 5%. Now 5% with the Reserve Bank's 1.5 to 2% real rate is still a repo of 6.5. Sajjid, you see 6.5 repo in 6 months?
Two things. I think we should not confuse targets and real rates because then the system is overdetermined. Ultimately, what the RBI's target is 6% by January and then a band of 4 to 6% over the next 2 years. That's the target. The real rate is whatever the real rate needs to be to reach that band. You can't have two simultaneous objectives, that I must have a certain real rate and a certain inflation target, because then in a sense the system is overdetermined. So what I'm saying is, even if you end up at 5, I'm not saying that's the RBI's forecast, our own forecast is 5.5. Okay. Right? Let's assume you end up at 5. You now have a band of 4 to 6. You're in the middle of that band. You're in the middle of that band at a time when every possible global and domestic force has moved in your favor.
That point is taken.
So I think you'll get a cut. I'll make
a cut? Brijen, a cut?
From the market's perspective, so really what's been driving bond yields has been the RBI policy credibility that it's gained over the past few months, and that is also evident in the way the bond market has hardly reacted to the global turmoil. So as far as the markets are priced in, they're looking at it fairly conservatively. If post FOMC we do see the market settle down, I would think we probably see on the 10-year yield move down of between 15 to 20 basis points. Okay. And then, again, like Sajjid mentioned, depending on the data, the market would look for more. Okay. But really, in the medium term, like you mentioned, if 4% is the target which is going to be achieved, and we're going to see a real rate of 1.5 to 2%, then, the timing is questionable, but we should see more cuts over the coming couple of years.
Okay, well, I'm just going to take a break from this discussion for a tad bit because we have the new listing, the management of the new company that listed back to the kind of growth that India will see. But in a space where there's so much global turmoil, do you think India can outperform? Because less than about 2 weeks ago, people were talking about the possibility of us being in a big global bear market with incremental pain coming in from China. How have you assessed the entire situation?
Well, I think, India does have the potential for relative outperformance and meaningful outperformance at that. Because, as I mentioned earlier, we're a little distinct from the emerging market pack because we're a net importer of commodities, particularly oil. And apart from that, we have two unique advantages. One is we have very favorable demographics, and the second is we have large need for infrastructure. So we are one of the few economies with the absorptive capacity to take a lot of capital. So I think, put these three in context. I mean, the favorable demographics, the need for infrastructure, the ability to absorb capital, and the fact that globally commodity prices are going to be very low, which is not very good for a lot of the other peer group markets. I think it's a reasonably potent combination.
But are you really confident of the executive capabilities of governments in India? Not just this government. Are you really betting on infrastructure, any infrastructure, capital goods?
I would bet on it on a 2-year context, Lata, because let's face it, our view has always been that given the challenging environment that this government inherited, it would take them a couple of years to clean up the mess and put the building blocks for growth in place. And I think they're doing that. I think they were 3 to 4 quarters into the process. I think it's going to take another 3 or 4 quarters. But there's no need to despair in terms of the growth in infrastructure. I think in 4 to 6 quarters we'll see a very different environment.
So all the road contractors, the L&Ts would be in your buy list?
I think what has happened is, to start with, the government, given the fiscal space, the limited fiscal space that's available, is focusing on 3 areas: road, rail and defense. And I think it's the right thing to do. You don't want yourself to spread yourself very thin early in the cycle. So I guess, yes, these are 3 areas that look very good to us. Companies that cater to these 3 areas. But down the line, I guess, other areas will get added to the space as and when fiscal space opens up.
Okay. Sajjid, come in on government spending, because the market is extremely optimistic about the 7th pay commission, the OROP, and the kind of spending it will unleash.
Right.
But realistically, what do you think could be possible?
I think you have to, for me, the composition of spending is almost more important than the quantum, because the overall fiscal envelope is now fixed. The deficit's 3.9, it's going to be 3.6 and 3%, and having already relaxed the target this year, unlikely the government will relax it again. So for me, the big positive was that with lower oil prices and a lower subsidy bill, it opens up much more space for capex spending. And frankly, over the last 6 months, there has been a big burst of capex spending. Now, of course, this is just intertemporal shifting. The more you spend now, the less you'll spend later. But I think what you're seeing from the government is a focus to spend more on roads, more on railways, some on defense, so that you can crowd in private investment. And we actually feel there are actually green shoots of capex, not in the traditional commodity sectors, but really it's public investment. We do see, if you look at capital goods production in the IIP over the last 6 months and smooth out the noise, or look at commercial vehicle sales, or look at NHAI's order book, or look at L&T's order book on the other side, you are seeing some green shoots of public investment related capex, which is positive.
Okay, a very small question on bonds, because you're so confident of fiscal spending. The OROP is an extra amount of money they have to spend. The tax receipts are not what the budget indicated at all. You're so confident of...
No, well, I'm confident that the target will be met. Now, how the target is met every year, we worry about the composition. I'll say some of the benefits are, with oil at 45 or 50, you will save up money both on your fertilizer subsidy bill and your fuel subsidy bill.
They were budgeted for that anyways.
Well, fertilizer was quite large, right? There is also a food subsidy element which you can play around a little bit with. Okay. There is challenge on the disinvestment target, no doubt about that. Indirect tax collections have been strong. Direct tax collections have been weak. My sense is, ultimately, if there has to be a spending squeeze this year, there will be a spending squeeze, because in this global environment where there's so much concern about emerging market macro fundamentals, I don't think the government's going to breach that 3.9% target. But next year, you make a very good point. To the extent that the wage bill is higher, whether it's OROP or other wages, is that going to squeeze out capex expenditure from the budget at a time when the private sector is highly leveraged, is a legitimate concern.
Then the worry is whether you should buy bonds at all. Is there an upside? Now, that's the question we want to ask you, and of course, what equities to buy after the break. We're back in a minute.
Then about 2 weeks ago, people were talking about the possibility of us being in a big global bear market with incremental pain coming in from China. How have you assessed the entire situation?
Well, I think, India does have the potential for relative outperformance, and meaningful outperformance at that. Because, as I mentioned earlier, we're a little distinct from the emerging market pack, because we're a net importer of commodities, particularly oil. And apart from that, we have 2 unique advantages. One is we have very favorable demographics, and the second is we have large need for infrastructure. So we are one of the few economies with the absorptive capacity to take a lot of capital. So I think, put these 3 in context. The favorable demographics, the need for infrastructure, the ability to absorb capital, and the fact that globally commodity prices are going to be very low, which is not very good for a lot of the other peer group markets. I think it's a reasonably potent combination.
But are you really confident of the executive capabilities of governments in India? Not just this government. Are you really betting on infrastructure, any infrastructure, capital goods?
I would bet on it on a 2-year context, Lata, because let's face it, our view has always been that given the challenging environment that this government inherited, it would take them a couple of years to clean up the mess and put the building blocks for growth in place. And I think, they're doing that. I think they were, 3 to 4 quarters into the process. I think it's going to take another 3 or 4 quarters. But there's no need to despair in terms of, the growth in infrastructure. I think in 4 to 6 quarters, we'll see a very different environment.
So all the road contractors, the L&Ts would be in your buy list?
I think, what has happened is, to start with, the government, given the fiscal space, the limited fiscal space that's available, is focusing on 3 areas: road, rail and defense. And I think it's the right thing to do. You don't want yourself to spread yourself very thin early in the cycle. So I guess, yes, these are 3 areas that look very good to us. Companies that cater to these 3 areas. But down the line, I guess, other areas will get added to the space as and when fiscal space opens up.
Okay. Sajjid, come in on government spending, because, the market is extremely optimistic about the 7th pay commission, the OROP, and the kind of spending it will unleash.
Right.
But realistically, what do you think could be possible?
I think you have to, for me, the composition of spending is almost more important than the quantum, because the overall fiscal envelope is now fixed. The deficit's 3.9, it's going to be 3.6 and 3%. And having already relaxed the target this year, unlikely the government will relax it again. So for me, the big positive was that with lower oil prices and a lower subsidy bill, it opens up much more space for capex spending. And frankly, over the last 6 months, there has been a big burst of capex spending. Now, of course, this is just intertemporal shifting. The more you spend now, the less you'll spend later. But I think what you're seeing from the government is a focus to spend more on roads, more on railways, some on defense, so that you can crowd in private investment. And we actually feel there are actually green shoots of capex, not in the traditional commodity sectors, but really it's public investment. We do see, if you look at capital goods production in the IIP over the last 6 months and smooth out the noise, or look at commercial vehicle sales, or look at NHAI's order book, or look at L&T's order book on the other side, you are seeing some green shoots of public investment related capex, which is positive.
Okay, a very small question on bonds, because you're so confident of fiscal spending. The OROP is an extra amount of money that they have to spend. The tax receipts are not what the budget indicated at all. You're so confident of...
No, well, I'm confident that the target will be met. Now, how the target is met every year, we worry about the composition. I'll say some of the benefits are, with oil at 45 or 50, you will save up money both on your fertilizer subsidy bill and your fuel subsidy bill.
They were budgeted for that anyways.
Well, fertilizer was quite large, right? There is also a food subsidy element which you can play around a little bit with. Okay. There is challenge on the disinvestment target, no doubt about that. Indirect tax collections have been strong. Direct tax collections have been weak. My sense is, ultimately, if there has to be a spending squeeze this year, there will be a spending squeeze, because in this global environment where there's so much concern about emerging market macro fundamentals, I don't think the government's going to breach that 3.9% target. But next year, you make a very good point. To the extent that the wage bill is higher, whether it's OROP or other wages, is that going to squeeze out capex expenditure from the budget at a time when the private sector is highly leveraged, is a legitimate concern.
Well, then the worry is whether you should buy bonds at all. Is there an upside? Now, that's the question we want to ask you, and of course, what equities to buy after the break. We're back in a minute.
CNBC TV 18, celebrating 15 years of leadership. Nifty TV18, celebrating 15 years of leadership.
Hi, welcome back to the show. Well, we have been in conversation with the Brain Trust of JPMorgan, and we had a very interesting discussion in the break about will she or won't she. We're talking about Janet Yellen and whether she'll hike rates or not in the September policy. And Sajjid, you had a very interesting view that she should perhaps go ahead with it this time because of the way the labor market is improving.
I think so, right? If you look at the U.S. domestic fundamentals in isolation, this is an economy at full employment. The unemployment rate's at 5.1%. It's fallen by 0.4 percentage points the last 3 months. This is now in the central tendency of what the Fed had forecast for 2016 and 2017. Right? So the whole promise of a calibrated increase, a very modest increase in rates over the next 2 years rests on starting at the right time. You don't want to be in a situation where you wait till December, the unemployment rate is below 5%, the economy is growing above potential, and then your promise that you have to raise rates slowly is not credible anymore. So I'd much rather you get this over with, get moving, because otherwise you're in this game theoretic solution where no central bank wants to move first. So it'll be good, given the data flow, the Fed moves and we begin to live in this environment where the ventilator is gradually being pulled out.
Okay, so if that is the global environment, that the yield is rising and therefore bonds will not be the preferred global asset class, here it is unlikely that FII debt investors are going to get too much of a headroom because everyone from the Prime Minister to Rajan don't want an appreciating currency. How much money is there to be made in gilts? 7.8 today. What is the best case 1 year down the line?
See, I think it depends on where commodity prices settle down post potential Fed hike, potential China stability. So the base case is that we are currently in a stretched environment. We will have commodity prices move up a little bit once markets stabilize. If that happens, then to achieve our 5% 2017, 4% 2018 target will probably require a slightly tighter policy for a longer period than we envisage. And therefore, the potential cuts may be more backloaded than we think at the moment.
So what is the average return on 10-year for the next 12 months? Does it get less than 7.5?
I would think, if you look at the coupon plus capital appreciation, the range should be somewhere in the region of 7 to 10, 11%. So
Okay.
it's a fairly tight range, not a whole lot. However, the point is, in this market of uncertainty, what's the kind of risk-return dynamics that as an investor you're looking for?
Okay, so let's talk about some stocks now, because at the end of the day, that's what makes money to all our viewers. Bharat, since you came in late for the interview, you have to give us some stocks that you're going to recommend. Okay, no, but jokes aside, what are the sectors that you think would lead the markets higher, say, in the next 1 or 2 years?
Well, Sonia, if I look at the next 6 to 7 months, we still remain very constructive on both IT services and healthcare. Basically because one, as Sajjid's been pointing out, I mean, the demand and the growth environment in the US and the developed world remains fairly solid. So I think the demand environment, remains very good for them. And as Lata rightly mentioned, I mean, the currency is going to have a depreciating bias. So I guess, that is a very potent combination. So we'd remain overweight on IT services and healthcare. Now, coming to the domestic economy, I think one still has to be selective. We are still not in rara growth land. I think we're still making our way up there. So early cycle, the preference remains for financials with a very solid capital and liability franchise, and secondly, manufacturing sectors, which have low financial leverage and high operating leverage, and which are very well tuned to the government's early cycle priorities of road, rail, and defense. So, what I'd include there basically is cement, commercial vehicles, and capital goods. These are the three segments which, from a manufacturing sector, look good, and as I said, on financials, stick to quality.
Okay, so just to put your views and Brijen's views in contrast, the JPM view would be that equities would return more than gilts.
Well, if I were to look at it on a 12 to 18 month basis, I wouldn't be surprised to see equities deliver more than gilts.
Okay. Well, would you bet on mid-caps, Bharat? I mean, we did see a fair amount of catch-up by the mid-cap space. Would your bets be equally placed on both sectors?
Not necessarily, Lata. At this point in time, see, first and foremost, I'll caveat it. I'll say that, mid-caps tends to be, they tend to be stock-specific, unique stories and themes. So it's very difficult to, talk about them as one holistic, homogeneous pack. That said, I mean, if you're going to put a gun to my head and ask me, you need an answer on this, I would say that immediate term, I wouldn't be surprised to see mid-caps, stop for a breather. Because what we've seen over the last 6 to 7 months is that mid caps have outperformed large caps meaningfully. And what we see in terms of valuations is both of them are now trading at more or less the same valuations. So, I guess, what you want to see is mid caps correct a bit and that valuation gap to open up again, or you want to see large caps move up. So, immediate term, I think, the mid caps probably take a breather and the large caps will have to do the heavy lifting.
Bharat, you say that you think there is a domestic growth story led by roads, railway kind of investments, and yet your maximum overweight is IT and healthcare.
Not necessarily. As I said, these are 4 themes we like.
Okay.
We like IT, we like healthcare, we like the high quality financials, and we like manufacturing sectors that cater to these segments. So I guess, it's quite evenly divided across these 3 or 4 themes. But yes, I mean, we're still not prepared to go down the quality chain in terms of the domestic cyclicals.
So when you say quality financials, can you just elaborate? Because, in the last 1 month or so, there's some concerns with regards to payments banks coming in and disrupting the entire banking system. And then, asset quality issues are only getting worse with so many metal companies now
exactly
coming
the
in.
reason, Sonia, we're sticking
But private sector banks too are getting impacted now.
Yes, again, as I said, I'm not making a distinction here between private and public. I'm making a distinction between quality and, not very high quality. So, you could have, banks in the private sector which are very high quality and which are not so high quality. And likewise, even in the state-owned banks. So, the distinction for us is in terms of quality, not in terms of whether it's state-owned or whether it's in terms of private sector.
And what about the distinction between NBFCs and banks?
I think as far as NBFCs are concerned, we've been underweight that space for quite some time now, and that stance continues. Because, as Sajjid mentioned, the potential for rate cuts is rather limited at this point in time. A lot of them tend to be borrowing at the wholesale end of the market. So, it's not going to get easier for them there. And secondly, we also have to appreciate, Lata, that a lot of them are very geared towards the rural economy. And there the distress is getting worse. Because, initially what you had was cyclical pressures, but now probably seasonal pressures are also coming to the fore.
So, no for consumption stocks of any kind?
Not consumption stocks of any kind, but rural discretionary consumption, I think, is going to be a no-no for some time.
So, no FMCG?
Well, it could mean motorcycles, it could mean tractors, it could mean, FMCGs, which are very highly geared towards the rural areas. Because, let's face it, these guys, don't get me wrong, the structural potential is enormous. But that said, they've had a cyclical party for nearly 8 to 10 years. And, policies turned a little on the other side, the seasonal factors are stacking up. So I guess, there are going to be better entry opportunities here.
Okay. Sajjid, the biggest shock for markets this year globally has been what's come out of China.
Right.
And, now, although the Chinese government themselves have scaled down their GDP estimates, nobody believes their growth numbers anymore. What is your own expectation of Chinese growth, whether there's more pain in store, and whether there's more policy action that one can expect?
I'm not sure that the China growth slowdown is the big surprise. China's been slowing for the last 5 years, and this year we expect growth to be below 7%. I think the worry has been that there has been this sort of impression globally that Chinese policymakers have these magic weapons, right? At any point they can tweak the economy and growth stabilizes. And over the last 3 or 4 months, you've seen various measures to tweak the economy, the stock market, the currency, and things haven't quite panned out the way people thought. That's been the source of nervousness, that our Chinese policymakers losing control. My sense is eventually they will stabilize the economy. We forecast that growth on a sequential basis actually re-accelerates in the 4th quarter. But let's step back and remind ourselves that China is on a structural policy-induced slowing. They want to rebalance this economy away from the old drivers of growth, which is investment and exports, towards domestic consumption. And that actually bodes very well for a country like India, because that means the same 6.5 or 7% growth that China experiences has a very different impact on global commodity prices, which help countries like India.
Okay, we got one number from Sajjid that there'll be only one rate cut. Let's get one number from Brijen. What's the rupee 1 year down the line?
I think, like you mentioned, the rupee is going to continue with its gradual depreciation path, 3 to 4% annualized, until our inflation and growth differentials change. So by around December of this year, I think the path may be different depending on how global markets go. We could overshoot. We'll probably end this year somewhere around 66.5 range.
Okay. All right, so
and Bharat, one number?
Yeah, one stock.
Nifty. Okay. Nifty level in 12 months or 18 months?
Nifty level, I think by the 2nd quarter of next calendar year, probably we take out the 9,000 high on the previous 9,000 high on the Nifty.
Okay.
Okay, that's all very optimistic. And one stock?
I'm afraid I can't mention stocks, but
well, you came in late. There has to be some penalty for that, right?
I'll mention that to you separately. But yeah, I mean, I've given you the sectors and the theme, so it's quite obvious.
All right, gentlemen, we'll leave it at that. Always a pleasure speaking with you guys. Thanks for joining us. And I'm sure all of the optimistic views are music to our investors' ears, because the market has been